Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site desk, we have Chris Dearborn and Max Cabasso, managing directors on Nasdaq's Market Intelligence Desk, as well as Michael Normyle, U.S. economist at Nasdaq. We're here to discuss the strong economic data that we've seen for the most part in 2024. It's great to have you guys with us as always. Welcome back to Trade Talks. And really, Michael, there's not much you can say that's bad about the economic data we've seen so far to start the year.
Yeah, it's been pretty much any way you want to slice it. Things have been pretty strong. You've got Q4 GDP came in at 3.3%. People were expecting 2%. We added 350,000 jobs in January. Unemployment stayed at 3.7. Initial claims a couple weeks ago, those were getting down close to record lows. The PMIs have been coming in stronger than expected. If you're looking at the S&P PMIs, manufacturing's back above 50. If you're looking at ISM, it's making its way there. Retail sales rose 0.6% in December, which was also stronger than expected. And consumer confidence is at a 2-year high. So really, things are looking good to start the year.
Yeah, and Chris, it's one of these things where good news is actually being digested as good news. We've always seen the inverse of that.
It's been a while, hasn't it?
Yeah, it has been.
I mean, you really have an expanding economic activity, which the market's kind of bullish on right now for the most part. I mean, the S&P is bouncing against that 5,000 number. Nasdaq 100 is making new highs. We had 5 of the big companies report last week. Mixed bag, but everyone beat on top line. But just the stocks reacted a little bit depending on whether or not you had the right AI configuration in your name or not. We'll get retail reporting over the next couple of weeks, and that's going to be kind of the key, the haves and the haves not. When you had some of the conferences at the beginning of January, ICR and a few others, people gave some preliminary guidance, and some were very much rewarded, others weren't. We've had a sprinkling of companies report. We'll see how that actually plays out, who actually won and who actually lost, and more importantly, what their guidance is moving forward. That's going to be the key here. But accelerating job growth, wages increasing, economic data is coming good. You're looking at inflation coming down over the course of the year, and expectations are by the end of the year we're going to have a lower terminal rate. So whether it starts in March, which it probably doesn't seem like it's going to now, or if it starts at the next meeting, it's 65% for May now. It's going to happen. It's just a matter of when, and that should be interesting.
Yeah.
Hopefully the rest of the market plays catch up with the larger caps.
Right. Well, but the thing is, if you're still in a higher interest rate environment, even if interest rates were to come down and you see small caps perform in response to that, that's one piece of it.
Right.
But you still need to beat earnings. You still need to have a profitable company. And I think that's why we continue to see that concentration risk in the market. The Mag 7s and other related companies, they have those healthy balance sheets. They are making money. Smaller cap companies, their balance sheets don't look the same.
Yeah, for sure. We actually just had a client here about an hour ago, and we were talking to him about it, just the divergence between small caps and large caps. And it's an easier decision for advisors, for fund managers, to put the money to work where it's working. You don't have those question marks of where the timing matters for rate cuts for people. And like we said, it's going to happen, but timing matters for a lot of these companies. What's their run rate? When are they going to have to raise? And for anybody that has questions, any fund manager, hey, am I going to start to put money to work in the small caps, which now it's at 21% underperformance over the year, Russell to S&P. Am I going to put money to work behind that? Or people are then going to start asking me questions if I'm underperforming by 20% because I decided to take a risk. With the small caps that have those question marks, it's an easier decision to put it to the large caps. And until they get that catalyst where those small caps get their balance sheets cleaned up or really start performing, it's going to be tough to put money to work there. So until they start to see that, I think that outperformance is probably going to continue with the large caps. Again, it's just an easier decision for somebody. You're not going to get questions from investors. Why did you go out and buy the Mag 7? Why did you go out and do this? That's what's been working. So it's kind of following that trend.
Yeah, and Michael, your team had noted last week we were talking about it, that even if interest rates or inflation is falling and the Fed does nothing, right, it's still, inflation falling is one thing, but if you don't have interest rates cut back at all, these problems are still going to persist for companies where cost of capital is high.
Yeah, exactly, because it's real rates that matter for the economy. So the nominal Fed funds rate minus inflation. And so this whole time that the Fed's been leaving rates unchanged at 5.5% since last July, inflation's been falling. So that means real rates have been rising. And so there's been this kind of implicit rate hike happening in a sense, right, where these real rates are rising, adding to costs for real costs of borrowing money.
Yeah, I mean, we've seen that in the housing market as well. It feels as if, you know, the housing market, smaller cap companies, other interest rate sensitive areas of the economy, it doesn't matter if inflation is going down to a certain extent.
Yeah, and you know, we've seen the nominal rates even rising lately too, with those rate cut, you know, expectations moving kind of the wrong direction a little bit, with rate cuts being pushed back more to, you know, May, June instead of March. So we've seen 10-year rates rise 20 basis points in the last week or so. That's also been a time period where we've seen mortgage rates move back above 7%. So we had seen mortgage rates get as low as 6.6%, but now they're back up with rate cut expectations being pushed back.
Yeah.
If they wait too long, bad things are going to happen. That's the problem, right? They're dual mandated by Congress, and you know the unemployment part's been there, you know, for a very long time. Price stability is not, right? And you know they're using a lot of different tools that they have, but the interest rates have to start to come down, and you have to get more to a real rate. You know,
We have a fiscal issue as well. There's a lot of debt that has to be serviced.
True. And we just had a major auction today too as well. That went off not terribly. So, and now you get the political. There's a lot of geopolitical items out there, not just to mention what's going to be happening here in the U.S. So whatever they're going to do, their playbook has to go into effect soon, right? Because if they hold off, it could get crazy with the election, and then the mudslinging that's going to happen and everything else that's going to be the market. And investors don't like putting the money to work in an uncertain market, and U.S. elections are an uncertainty that people are very nervous about. If you look at the two front runners continue to be where they're going to be, whatever may happen, look at the voter turnout from the last election to this election. It was tremendous. We'll see if we get that, but either way, markets don't like it, which is going to affect not only the cost of capital raising, which is the discussion we have with the CEO today, what we've had with other small cap companies before. It's very expensive. You know, you're talking 25-30%. It's going to cost, so every dollar they raise, they only get to keep 65 or 70 at this price point.
Yeah.
So that's going to.
Could it impact the IPO market and
Absolutely.
raising, you know, capital in other forms as well?
It will
No one likes
100%.
uncertainty.
It will 100% impact the IPO market. People are going to look to get out, meaning become public before we go into the summer months. So hopefully it'll be see a ramp up. We'll see how that goes, and then, you know, the pipeline's big there, so we'll see how that works out. But once the election comes, you know, especially when you get into the dog days of September coming into October, and then finally that last week, couple of days in November, it's never a good time at the marketplace. It's going to be but once the election takes place, regardless who wins, stability is good, and you generally see the markets react positively for the most part. Once you have, regardless of the incumbent or the new coming in, stability is good for investment, and whether or not you agree with everything or not, one thing's certain: the markets and investors
The
want
election
stability.
is over for the most part.
Yeah.
Let's pull up a couple charts here.
We hope.
Right. Taking a look at actually the S&P continuing to hit new highs. We'll take a look at the VIX as well. Clearly the inverse of that. The way the S&P is trading and how muted the VIX is, the market doesn't feel too uncertain.
Yeah, I mean, again, it's led by some of the larger caps, but as you see here, we're breaking out to new highs here. We kind of went sideways for, felt like 3 days, thought that might last a little longer, might have a bit more volatility here, but that never came up. 5,000 is a big psychological level, but again, we're at new highs in the S&P. You know, would not be surprised to see this again continue to break out. We're there. 5,000 has kind of been the level to watch. We've been chugging along. All right, are we going to get it? We have 52-week highs, but new all-time highs weren't there. We're there now. Obviously, when it comes to technicals, once you hit new highs, there's nothing above you to kind of slow you down. RSI isn't too high, so there's a lot of support here and momentum, again, for these large caps, not so much the small caps. So, to the downside, maybe 4,800 if we take a bit of a breather, but there seems to be no sign of letting up here.
It's pretty healthy above the trend lines that you have drawn there.
We're definitely above the trend lines here. 50-day is down at 47.50. 200 is down at 44.54. So again, plenty of room down there, but we're well off those key levels. And again, there's a lot of tech, which has been really leading this market. So there's a lot of tech coming out today, tomorrow, are kind of the two big days for tech earnings. So would not be surprising to see this get picked up. Today, solar is actually picking up. They had coming off the worst days. Started to see a lot of companies in their earnings, especially S&P companies, that had kind of called the bottom, essentially. There's one in solar today that called the bottom, said, okay, the worst is behind us. Had a conversation with another one in the semiconductor space, basically called the bottom, said, we think the worst is behind us. Even if earnings don't, shake out, the reaction isn't great here. We're very confident that we've kind of cleared out our channel. We're ready to go, and the next year, 2 years, we're in a really good place to kind of take off. And that's commentary, again, in multiple sectors, all focused on tech, but people seem to like they're in a good spot. So again, doesn't seem to be much overhead concern. And if we start to get some cooperation from the Fed, more of a tailwind there to really take off. And again, there's nothing overhead outside.
So pull up the VIX for a moment here, right? Because of course, you're going to see somewhat of an inverse too with the S&P for the most part. I wonder if that is the function of the market focusing on earnings and fundamentals and not just being in this tunnel of the Fed interest rates and macro. I mean, that kind of happens with every cycle.
It does. It's a stock pickers market at the moment, though. Really, it's the have and the have-nots. You look at the large caps versus the small caps. We've talked about all the time. Small caps are losers for the most part right now. If you look at Max's point, you look at the Russell, even the Russell Micro. At that, you're down 3, almost 4% year to date, where the other indexes are up 4 to 5, if pushing 6% today on the NDX. Where's the money being worked? We talked about over multiple times, and we write about it, and you've written about it too. You got $1 trillion that went into money market funds last year, getting guaranteed 5%. Once rates start to come down, whether albeit it's May, June, doesn't make a difference. Whenever it starts, that money's going to get put to work. So where's that money going to get put to work? Is it going to go into the large caps, or is there going to be a tail? Once you get that tail, then it's blast off across the board. Right now, it's just like COVID, and we've gone through this before. You have the head going forward. Yet, it was Apple back then, and it was Amazon and other companies that really took off out of COVID, and you got a select few here as well, right? You go from FANG to Magnificent Seven. So does the market follow? The market will follow, but you just need the macro to step into it.
Yeah. Well, it's interesting what you're saying about the money that's on the sidelines. We actually just did an ETF panel before you guys had come on, and Michael, it's interesting. They think a lot of the flows that come out of that, because there is so much in the money markets right now, they expect to see some pretty significant flows into the ETF space as well.
Yeah, I think that makes sense, right? You've seen the rise of passive investing over the last 10 plus years, right? So, like you're saying, when you're not getting 5% guaranteed rate anymore, you're going to start looking around for different investing options, and I think ETFs are something that make a lot of sense for retail investors. All
right, and finally, let's wrap up this chart that you have up here, Max.
Yeah, so again, this is the difference between S&P and Russell. This is over a 1 year period. It's interesting, you see the low was March of 23. That was the only time that the Russell had outperformed. Since then, we're now peaking. We're just under 21%. We haven't seen these levels in the entire year, despite the massive outperformance. So it's not closing. The gap has not been closing as much as we've been waiting. I've been kind of waiting. It's one of those trades kind of look at like, the jaws have to close at some point. The Russell has got to start to pick up, and it's not happening. It's only getting wider. We saw it start to come in at the end of December. When we started to get the cadence getting louder and louder for a Fed rate cut in March, small caps started to outperform. Everybody thought, okay, this is the time. Now the small caps are going to be able to get their financing. It'll be cheaper, and they could start to perform again and clean up those balance sheets. And then once that started to come off again, it's flipped. We're going back out. Large caps are winning even by an even wider margin at this point. And again, really not much slowing down here. It seems steady. It's only getting wider and wider at this point. And again, as the Fed continues to wait, March, now May is down to 60%. When it happens, I don't know, but until that does, the small caps are probably going to continue to underperform.
Yeah, that's the Michael's point before, right? About interest rates and inflation. As inflation comes down, the interest rates don't adjust, it's going to be a problem for people moving forward, not just on a personal level, individual level, but on a corporate level. Yeah. That's something's got to give.
All right, guys, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.